If there's one thing that Canada's financial sector has gained a reputation for all around the globe, that is being resilient through financial crises. Canada is not a country that gets put in the spotlight very often, but something that business people all over the world recognize about Canada is that it has a very strong and very sound banking system. Although the market is dominated by the big banks, which collectively manage around $5.5 trillion in deposits and manage roughly 90% of Canadians' assets, the sector is well regulated and has been well managed for the most part, with a few blips along the way. But within this sector lies one particular component which is long overdue for a major change, and that is Canada's investment industry, or more specifically, the investments that average Canadians rely on to build wealth and save for retirement. Canada pays some of the highest investment fees in the entire world, averaging about 1.8% of their invested assets compared to most countries which are around 1% or even lower than that. And the more I've researched this topic, the more I've realized that the industry is stuck in the past and it's just designed to extract wealth from the average Canadian rather than help them maximize their returns. For decades now, many Canadians have been pushed into high fee, actively managed mutual funds, many of which can even outperform a basic index fund, which is especially true after accounting for those high fees. A study that was done on Canadian equity funds found that less than 1 in 5 of these funds beat a benchmark index over a 17-year period, and when you account for fees of just 1%, it drops to 1 in every 10. So, in this video, I want to talk about what exactly is the problem with Canada's investment industry and why these issues have persisted for as long as they have, and then also what you can do about it to personally put yourself in a better position. Now, if this video that you're watching right now got sent to you by the YouTube algorithm, it's highly likely that your level of financial education is higher than that of the average person. For example, if you're someone who studied business or economics or even a related subject in school, or even if you've just read a few books about the topic of personal finance, you've probably learned more about this subject than most people have. The reality is that most Canadians, or citizens of any country really, don't really have the interest, or in many cases, don't really have the time to spend to learn about these subjects and educate themselves on the topic of personal finance and investing. But it just so happens that it's this one unique topic where pretty much everyone at some point in their lives is going to be forced to learn about it. Other topics like physics or science or even math, really, you can pretty much get through life without ever having to really learn how those things work. But investing is the most reliable way of building wealth and saving for retirement, so at some point, everyone is going to need to have some understanding of how to properly invest. So what most people will do is outsource this to financial advisors, people who understand money and can support them through their journey of building wealth. So this puts financial advisors in a very privileged position where they're offering a service that people need, but the people they're offering it to don't always fully understand the service that's being provided to them. So this is where regulation must come into play to ensure that financial advisors don't take advantage of this privileged position that they're in. This is where the idea of a fiduciary duty comes in, which states that someone who is in a privileged position is required to act in the best interests of the people that they represent rather than themselves. Now, in the United States, registered investment advisors have a fiduciary duty to act in the best interests of their client. But in Canada, this doesn't exist for all financial advisors. Instead, they operate under the suitability standard, which means that they only need to provide recommendations that are suitable for their clients' investment goals. And this can include investment funds with excessively high fees, which often do get pushed because of the commissions that they give to financial advisors who are really just salespeople trying to sell these products. They're called embedded commissions or also trailing commissions, and these are fees that get paid to financial advisors from the fund companies on an ongoing basis as long as the investor continues to own those funds. The issue that this presents is that these fees are largely hidden from the investor, and the fund company can just take the money directly out of the investor's account. So a lot of the time, investors don't even realize how much they're paying in fees. And it's not just difficult to find out how much you would pay in fees as a percentage, but also what you would pay in fees as an actual dollar amount and what that dollar amount would look like over your entire lifetime. A study that was done by the Mutual Fund Dealers Association found that less than 1 in 5 Canadians were able to correctly identify how much they're paying in investment fees. And it's not because all Canadians lack the knowledge, it's because these costs are purposely made difficult to understand, because if they were understood, then no one would be paying them. And the data data is clear that the fees on commission based funds are significantly higher than on any other class of funds. They're still over 2%, although they have been steadily declining over the past decade. It's still higher than fee based funds, which is when the financial advisor is paid directly by the customer, and well below ETFs, which are by far the cheapest option out there. And although ETFs have been growing in popularity in Canada, mutual funds still dominate the investment industry. Canadians have about $2 trillion invested in mutual funds versus just 400 billion in ETFs, which typically cost much less and do provide similar levels of performance. However, the good news is that fee-based funds have been gaining in popularity, and under fee-based funds, advisors get paid the same amount of fees regardless of what their client has invested in, whereas when they get paid based on commissions, they're incentivized to push the funds that give them the highest commissions, which tend to be the ones with the highest fees. A 2023 report by the Investment Industry Association of Canada stated that from 2020 to 2023, commission based moved from 41% of mutual fund assets down to 36%, while fee based grew from 19 to 26%. So clearly, the industry is trending in the right direction, but still, most Canadians are stuck paying these higher fees. So the question is, why has this problem persisted? Why are so many Canadians stuck paying these high fees for what is essentially worse performance? I think the answer really comes down to two things. One is a lack of financial education, and the other is a lack of competition within the industry. The Canadian fund market is dominated by Canada's big banks, who control the creation of these funds as well as their distribution to Canadian customers seeking financial advice. So they do have a very clear incentive to sell their own funds and keep that business themselves. Many of these banks don't even allow investors to purchase low cost ETFs offered by other companies like iShares or Vanguard when they visit an advisor at a branch. For example, let's take one of Canada's biggest equity mutual funds, the RBC Canadian Dividend Fund. This fund has an MER of 0.78%, which may not sound bad, and for an actively managed fund, it is a reasonable fee. And the fund has returned 10% annually over the past 5 years, which is a solid return, assuming that's net of fees. But there's also the Vanguard Canadian High Yield Dividend Fund, or VDY, which is passively managed and gave better performance of 12% annually over 5 years, with a much lower MER of just 0.22%. Now, I do recognize that these two funds are not the exact same thing. They may have slightly different investment goals and levels of risk tolerance, even though the end result of what they produced in terms of returns was very similar, and they're both high yield dividend paying funds. But the point I'm trying to make is that if you just go to a bank and you just rely on a bank for financial advice, you may not even be aware that these other options exist that offer cheaper fees. Canada's banking sector is very heavily regulated, which can be both a blessing and a curse. It can be a blessing because your money is likely going to be safe in the long run and the industry is going to be very stable, but it's also a curse because less innovation is allowed to happen. And the banks do have a lot of power when it comes to deciding what regulation actually ends up being implemented. Earlier in this video, we talked about trailer fees, which is when financial advisors earn commissions selling high fee products to customers. Well, in 2017, the CSA, which is the regulatory body to help harmonize regulation across the different provinces in Canada. Remember, Canada doesn't have a national security regulator like the US does with the SEC. They have provincial regulators like the OSC. So the CSA actually proposed banning these fees altogether because of the blatant conflict of interest they presented to Canadians seeking help with their finances. So, in response to this, the Investment Funds Institute of Canada, which is the industry association for mutual funds, or in other words, a lobbyist group, they argued that eliminating these fees would reduce access to investment advice for smaller investors, since they believe smaller investors prefer to pay for advice through these embedded fees, and this would make servicing those accounts more expensive due to the increased compliance costs. So, what ended up happening is these fees were only banned for discount brokerages who usually don't provide financial advice anyways. So, as of today, these fees are still allowed to be charged. And again, most Canadians have no idea exactly how much they're paying. And then in 2016, the OSC looked to introduce new regulations that would introduce a best interest duty when financial advice is given to retail investors. But again, this regulation never came to fruition as that same lobby group successfully dissuaded the regulators by again arguing that this would increase compliance costs, making things more expensive for investors if they were to introduce something better than the suitability standard, like a best interest standard. So basically, what they're saying is that these smaller accounts aren't profitable for them unless they're allowed to charge them excessively high fees. And what was perhaps the biggest form of regulation that actually got implemented was called CRM2, or Client Relationship Model Phase 2. This was new regulation designed to make it easier for investors to see exactly how much they're paying in fees. It required a investment performance report, which was a standardized report where investors could see how well their investments were performing, as well as a cost report, which showed exactly how much in fees the investor paid, and it presented this in dollar amounts and not just as a percentage of their assets. And it took years for this to finally get rolled out because of all the pushback it received from lobbyists. It was initially proposed in 2012, but didn't get fully implemented until 2017 due to the backlash it received from the industry. And even now that it's implemented, there's still some issues regarding investors' ability to understand these reports and actually reporting the correct information, as many of them were found to have errors in them. And again, this comes down to the lack of financial education, where investors don't always know how to interpret this information, which I think is also part of the problem. And this does show a pretty clear pattern, which is whenever these regulators have tried to implement new changes that can help benefit investors, these changes tend to get struck down by the industry, and overall, regulators just haven't been very successful in getting their initiatives implemented. Now, to be clear, there's nothing inherently wrong with mutual funds or even actively managed mutual funds. Active management plays a crucial role in financial markets. It is a good thing to have large institutional investors that are analyzing investments from a fundamentals perspective. Plus, they give investors more options to choose from if they feel that those active strategies are worth pursuing, which overall makes the industry more competitive and leads to better outcomes for the average investor. But not all of these actively managed funds that charge these higher fees are that different than a passively managed fund that just tracks an index. It's this issue called closet indexing, where a fund company will claim that they're actively managed and charge the higher fees, and the fund manager pretends to be researching and picking stocks, when in reality they're just hugging the index to avoid underperforming it by too much. And many people don't regularly check a fund's underlying holdings, so they can get away with it. A study that was done back in 2013 estimated that more than half of assets managed by Canadian funds are actually closet indexers. And although this was done 10 years ago, there hasn't been any regulatory action taken to combat this practice. The issue it always runs into is how do you define closet indexing? There was, however, a class action filed against one of Canada's largest mutual funds, alleging it was a closet indexer because its performance was eerily similar to that of the TSX 60 index, even though it was charging much higher fees. But they lost the case because the lawyers argued that closet indexing must involve some degree of deception or dishonesty from the portfolio manager, and because the portfolio manager was being compensated to outperform the index and did make the decision to exclude key Canadian stocks like Shopify, for example, due to concerns over its valuation, which did show that they were looking at stocks from a fundamentals view. But the fact that a case like this even existed in the first place and ended up going to a trial shows that Canadians are getting frustrated with paying high fees for poor performance. And I think the more you learn about this industry, the more you realize that it's really just people who don't want to lose their jobs and don't want to take any excessive risks with their investing that may make them look stupid if they end up being wrong. Now, for my critics out there who want to make the point that Canada's fees are higher because of the way the Canadian market works, is that financial advice fees often get bundled with the cost of the management of the fund. In other words, Canadians are usually paying for both financial advice and the fund management when they pay these high fees, whereas other countries may charge these two things separately. But what I would argue is that if these fees are embedded within the fund, then they're not visible to the investor who may not have received any advice to justify the fee in the first place. And it all goes back to this common theme of ensuring people aren't aware of just how much they're paying. Now, the good news is that younger investors are starting to become more fee conscious. Nearly one third of millennials that work with a financial advisor saying they're planning on quitting working with them, and 31% of Gen Z say they'll do the same in favor of DIY investing. And something else that discount brokerages have been offering are robo advisors, which is basically software that selects investments for you based on your financial goals. But robo advisors have largely failed to take off, and I think the reason for this is because managing people's money is a relationship driven business. You're dealing with the emotions of everyday people when it comes to managing their money, so software just isn't going to work. There was a survey done by Morningstar asking people why they use financial advisors, and most of the reasons that they gave were emotional reasons versus financial ones, things like behavioral coaching and their level of comfort in handling their finances. So we have to acknowledge that this is a relationship driven business. So if you do choose to work with a financial advisor, it's always important to check if they have a professional designation, something like the CFP or Certified Financial Planner, which signifies a commitment to the fiduciary duty where they must act in your best interest and not just to the suitability standard. And you can also ask how they're compensated. Do they earn commissions on the financial products that they invest in for you? And of course, check the management expense ratios on the funds that you own. If it is a passively managed fund, then the fees shouldn't really be higher than 0.5%. Ideally, it should be a lot lower than that. And if it is an actively managed fund, if you feel that those are worth pursuing, then the fees will be higher, but they shouldn't really be anything higher than 1%. Anything that gets into the range of 1.5 to 2% or even higher than that is likely a bad deal. But personally, I think the best solution is to take the DIY approach. We're really in this golden age of investing right now, where with low cost ETFs and discount brokerages that offer free trading, pretty much anyone with any amount of money can get started on their investing journey without having to pay someone to do it for them. So I'd always encourage people to educate themselves and understand how you can make best use of the tools that are available to you. But anyways, guys, that does it for this video. So I hope you did enjoy it and you found it useful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.